Hello, everyone. Bailey Peachy here again, and welcome back to part 2 of our Trade Business Accountants Cash Flow Masterclass. We're an accounting firm that works exclusively with Australian trade and construction businesses, turning anywhere between $1 and $10 million a year to help them build greater security in their business by dramatically increasing their profits and cash. Now, the reason for this training is for everyone less than $1 million a year. We want to help you get there so that maybe someday we can work together. At the very least, we just want to provide you value. And for everybody above $1 million a year, we want to help you simply do better. And at the very least, showcase what we know. And maybe somewhere down the line, you'll consider hiring our accounting services to help you do all this. So let's dive back in. As promised, a real life TBA client case study. Meet Ben. Ben's story starts back in 2020 when he first reached out to us looking for more guidance in his business. For privacy reasons, I'm going to refer to his business as ABC Plumbing. Now, Ben is a first-generation business owner. His parents were hardworking employees, so were his grandparents, as well as pretty much everyone else around him. He knew a few people who had run some smaller businesses, but he never really had any sort of successful business mentor in his life to seek advice from. So for close to a decade, Ben put his head down and he worked his ass off. And while it took some time to build that initial momentum, after the first 5 years, Ben had grown to $1.4 million in 2018, then to $2.6 million in 2019. And in the last 2 years, he grew to over $3 million. In Ben's own words, business was great. He proudly explained to us that between 2020 and 2021, revenue had grown by 17%, going from 2.9 million to 3.4 million. Operating profit was up 19% from $311,000 to $383,000. And Ben also said that after interest and tax, ABC Plumbing had made over $172,000 in net profit, up 21% from the previous year. Everything looked good. Every financial KPI was moving in the right direction, and Ben was proud of his numbers and of his growth. But he just wasn't sure why he kept having little money in his bank account to show for it. And he wanted to understand, hey, where is all my money going? So I want to ask you a question, and I promise you this isn't a trick. Looking at the financial statements of Ben's business, how much cash did he make in 2021? I'll give you 30 seconds to have a think about it and come up with an answer. Now, I'm guessing that some of you might have answered $172,000 from his net profit, or you might have also thought, hey, maybe it's $0 because you can see that there was no change in the cash at bank on the balance sheet. These are definitely the most common answers that I get when I ask this question. But the reality is Ben's business actually lost negative $270,000 in 2021. Ben lost $270,000 in the same year that he thought business was great. But how did this happen? Revenue was up, gross profit was up, operating profit was up, retained profit was up. Every financial KPI and trend were pointing upwards and in the right direction. ABC Plumbing was growing profitably. So how in the world could Ben possibly be losing money? I say the same thing in just about every single presentation that I do. Revenue is vanity, profit is sanity, and cash is reality. Cash is the lifeblood of your business. It's the oxygen. You can get away with okay people, okay strategy, and even okay execution. But if you run out of cash, it is game over. For many years, I've worked with trade business owners across Australia, and they all face the same challenge. Not enough cash left over in their bank account. You see, in life, managing money is a pretty easy concept to understand, but in business, it can be a lot more challenging because there are just so many more moving parts, and it can be very easy to get lost in all that noise. But managing your cash flow has never been more important than it is in today's business environment. Costs are rising, inflation is rising, there's greater volatility, there's more red tape, there's more uncertainty, and even on the positive side of things, there's even more opportunity to grow and expand. There's never been so much work available to anyone in this sector than there is right now. But all the same, cash is vital. So I want you to really think about this for a moment. If this was your business and you were staring at these financial statements, would you feel 100% confident that you were making the right business decisions to make sure that you weren't going backwards? If you were running this business, would you have known that you actually lost over $270,000 worth of cash? And would you have known why? Ben was doing all the right things. He was growing. He was profitable. But here's the problem. I'm an accountant by trade, and the profession that I belong to have made cash flow so complicated to understand that no one actually knows what it is, right? So today, my goal is to make the complex simple, because chances are either right now or at some point in the future, you could find yourself in a very similar situation to Ben and ABC Plumbing. So first things first, let's define cash flow. If you start the year with $100,000 in your business bank account, and after 12 months, you finish the year with $150,000, then your cash flow was $50,000. This tells us that you've made $50,000 in cash. Pretty simple, right? The problem though here is that many business owners don't know how to measure cash flow as simple as this from their own financial statements. And typically what I see happening is that they only look at their profit and loss statement. Now, I believe this is because the profit and loss is simple to understand. There's a natural flow and business owners can look at it logically and they can understand that. But cash comes in, cash goes out, and you're left wondering why the profit on your profit and loss statement doesn't reflect what's actually sitting in your bank account, because this is your paper-based profit, not cash in the bank. There have been plenty of great contractors out there that were highly profitable on paper, but they still went under because of a cash problem. And I'm sure many of you listening right now can probably relate to this situation at some point in your business journey where you're really busy, sales are up, you feel like you've got plenty on, but you never seem to have enough cash in the bank account. Revenue is vanity, profit is sanity, and cash is reality. There is a big difference between profit and cash. Profit and cash are not the same thing. Profit is the result of your profit and loss statement. Cash is the result of your business. And what I mean by that is looking at your profit and loss statement alone will not tell you anything about the health of your business and how much cash you've made. All it's going to give you is the sales you've made minus your expenses and then the paper profit that's left over. Nothing about assets purchased, how much money you're owed, when you're paying suppliers, works in progress, director's loans, and all these other elements of your business that have a real dollar cost attached to them that do affect your cash, not the profit that you're seeing on your profit and loss statements. So this means that you're not getting the full picture of your business or how much cash you've made just by looking at your profit and loss. It doesn't tell you anything about cash because there just isn't enough information on there. So to understand your cash, the result of your business, which is the money left over after everything else has happened, you need to also understand your balance sheet. But this is where many fall short because the balance sheet to many is complicated, but it is equally as important as the profit and loss statement when it comes to understanding our cash. And it's the only way to get the full picture of what's really going on in your business. I can't tell you how many businesses that I've come across over the years who are really profitable on paper, but we're still on the brink of going under. Profit on paper doesn't pay bills. Cash does. You and your team are making decisions every single day. And if you don't understand the impact of these, you or your team could actually be doing things that are detrimental to your business. So you cannot afford to run your business with a blindfold on. Decisions must be made off of facts. The biggest danger to you right now is what you do not know about your business. You need to understand your cash, and this means understanding your full story. Now, to make understanding the cash flow in your business simple, you need to look at your numbers as a story that is told over 4 chapters. Net profit minus working capital invested minus other capital equals your cash. Cash is the result of your business, the result of your story of numbers. So let's start right at chapter 1. Chapter 1 is net profit, the profit that your business makes after every cost has been factored in. This is the figure sitting at the bottom of your profit and loss statement. And this, as I was saying, is what most trade business owners use to understand the health of their business. But your profit and loss is lying to you. And as the great Alan Mills explains, you need to think of understanding the cash in your business just like reading a murder mystery. You cannot read chapter 1 of the book and then just expect to know who the murderer is, because that's all revealed at the end. If you want to understand who the murderer is, you have to read the whole story. And the same is true for your cash flow. You need to read all 4 chapters, not just chapter 1, net profit. Because just like you would have seen in the case study example of Ben with ABC Plumbing, revenue might be growing, margins might be up, and profit could even be increasing, but this doesn't tell you how much cash you've actually made. So to find net profit, just go straight to the bottom of your profit and loss. Here in Ben's business, you can see that his net profit was $172,000. And looking back at the 4 chapters, this is where net profit sits in the equation. Now, you can see here that it's sitting in the left-hand column that positively affects cash flow. And this is because increases in profitability have a positive effect on the cash flow in your business. The more profit that you make, assuming that you're collecting all of it, the more cash your business should generate. The next chapter that we need to look at is working capital invested. Working capital is simply the amount of cash needed to run the operations of your business. And this is where the balance sheet comes in. Now, there is a lot going on here, and it might appear a little bit more complicated than the profit and loss statement as we've just gone through. However, out of everything listed in the balance sheet, there are only 3 lines that you need to worry about when it comes to working capital. Those are accounts receivable, your works in progress or stock, and your accounts payable. Your accounts receivable is just a fancy word that accountants like to use to explain the money owed to you from your customers. Your WIP or your works in progress are the work that you've done at your expense that you have not yet invoiced for. Your stock is pretty similar to this. It's just the supplies that you have on hand that are waiting to be allocated to a job to then be invoiced. And then finally, there's your accounts payable, which is the money that you owe to your suppliers. And these 3 line items are known as working capital because they determine the amount of cash needed to run your business, right? To fund your operations. And they largely dictate the amount of cash coming in and the amount of cash going out of your business. So you can be wildly profitable in chapter 1 on paper, but if you're collecting cash slowly and you're paying suppliers quickly, you're going to find yourself in hot water. Now, we're not looking to calculate the total working capital in the year here. We're actually looking to calculate the working capital invested this year on top of last year. And this is because what we need to do is determine if our profit that we made this year was required to fund any increases in working capital from the year before. And this is important because profit is the only source of internal funding that we can use to cover any increases in working capital. So again, all that means is any increases in the amount of money that we require to run and fund our business, to run operations, to keep the doors open, right? So if we don't have enough profit, what we'll have to then do is source funding from outside of the business, like loans from a bank and so on. And while there definitely are some exceptions, I believe that a healthy business should largely be able to fund itself. So the formula here is difference in accounts receivable. That is the difference between 2020 and 2021, plus the difference in WIP or stock, minus the difference in accounts payable, equals the working capital invested. So if we look back at our balance sheet here, accounts receivables has increased by $159,000. So that's $716,000 minus $557,000 equals the $159,000. Now, WIP or stock has increased by $328,000 and accounts payable has increased by $126,000. That means all up, ABC Plumbing has invested an extra $360,000 into working capital in 2021 compared to the prior year, 2020. So looking back at the 4 chapters again, this is where working capital invested sits within the equation. Now, you can see here that unlike chapter 1, net profit, working capital invested is sitting in the right-hand column that negatively affects cash flow. This is because the more working capital, the more cash your business needs to fund its operations. And if this is getting a little bit tricky, just bear with me because this will all make perfect sense in a moment. Once we know the total increase in working capital, we then arrive at chapter 3. This is where we need to determine if there's been any increases in other capital. Now, to make the balance sheet simple, anything outside of working capital, which is what we just covered, those 3 line items, we just call other capital. So these are complicated accounting terms like accruals, repayments, provisions, deferred tax, other current assets and liabilities, and so on. But they have little to do with the operational management of your business. So don't worry too much about those. Just leave that for your accountant and we'll just group them as other capital. Now, to calculate other capital, we again need to look at the balance sheet. Here we look at difference in equity plus difference in debt. So equity is the value that would be returned to shareholders if all the assets were sold and all the company's debts were paid off. Debt simply represents the value in a business that is owed to creditors like banks. But the combination of these two represents the total increase in funding or capital in the business in 2021 that was used to fund the increasing costs of operations in 2021. So by subtracting the working capital figure that we just calculated from this total, we can then calculate the leftover, which is other capital invested in 2021. All up, the formula for other capital looks like this: difference in equity plus the difference in debt minus the working capital invested equals the other capital invested. So looking back at our balance sheet, equity has increased by $172,000. The combination of short-term and long-term debt has increased by $270,000. That means that all up, once we subtract the working capital amount of $360,000, the business has invested an extra $83,000 in other capital in 2021. Now, looking back at the 4 chapters again, this is where other capital invested sits into the equation. And you can see here that again, it's also sitting in the right-hand column, negatively affecting cash flow. This is because just like working capital, the more you invest in other capital, the more cash that is getting drained from your bank account. And that brings us to our final chapter, chapter 4, cash, the result of your business and the money left over after everything else has happened. To calculate cash, we simply revisit our original 4-chapter story formula. So after making $172,000 in profit, you might remember that Ben had actually lost over $270,000 in cash, which at the start of this training likely came as a bit of a shock. But you now know that the story of your numbers is made up of 4 chapters. And while chapter 1, net profit, in Ben's case was up $172,000, we needed to read the entire story to get the full picture of his cash flow and really to understand where all his money was going and, more importantly, why he didn't have any. So the golden rule of any thriving trade business that makes a bucket load of cash is that profitability must be greater than the investment in working capital and other capital combined. You want to increase profits and decrease working and other capital. The greater the difference between these two, the more cash you will make in your business. For example, if you were to increase profitability to $400,000 and then decrease working capital by $200,000 and then decrease other capital by $50,000, you would end up with positive cash flow of $150,000. So the business would make $150,000 in cash rather than losing $270,000, which is a massive difference. But that would be the result of understanding how to read your story, because this is how you can flood your business with more cash, increase profits and decrease working capital. Where most business owners go wrong, though, is that they end up going the other way, where working capital invested and other capital invested is greater than their profitability. And this is a serious danger zone, because whenever chapter 2 and 3 need more cash than what chapter 1 can produce, volume becomes detrimental to cash. The more you grow, the worse cash becomes. Every new sale will only hurt your business further, which is why when contractors are struggling for cash and they try to fix the issue by, what I call working harder and going out there and making more sales, things often only get worse. Or another one is typically when contractors grow and expand, they often seem to make less money because they don't understand the numbers behind their business. And because of that, they do not understand how to actually improve them outside of just trying to get more work through the door. But like I said, if working capital invested and if other capital invested is greater than your profitability, then more work will not solve anything and it will only make things worse. Volume will be detrimental to your cash flow. So let's recap. If chapter 1 is greater than chapter 2 and 3, you make cash. If chapter 1 is equal to chapter 2 and 3, you make no cash. And if chapter 1 is less than chapter 2 and 3, you lose cash. Now, where you have the most leverage and where our clients get the biggest wins is in chapter 1 and 2. And probably sounding like a broken record here, this comes down to increasing your net profit and decreasing your working capital. As the business owner, you have massive control over being able to increase net profit and decrease the working capital invested in your company, which brings me to one of the most important sections of this entire cash flow masterclass, something that I know you're going to find incredibly valuable, and that is the 7 levers.